Good evening, everyone, and welcome to our election-focused webinar this evening. Hoping to enlighten you on some of the tax changes we may be seeing following today's election. So this evening's really all about looking at what the different parties are telling us they'll be doing with our taxes, so that as property investors, we can really start to assess how the coming changes may affect our decisions on when to do something or change our plans on how we're going to go about doing something. Tonight, I'm going to really look at the main parties, as they will likely be the ones driving the picture. Whether we have a majority or a hung parliament, it is anybody's guess today. So I'm hoping you've had a chance to go out and vote, or you'll be going out and vote after the webinar tonight before the polls are closing. But this evening is not about any political opinions. I'm sure we all have our opinions, but this really is a focus on what could happen, so that we can just really be starting to think about how we go about dealing with those changes and finding the opportunities where we can. Now, the implications I'm really going to be trying to focus on tonight are really how we're structuring our businesses, how we're structuring our deals, the corporate tax implications, so if we're doing things through a company, and the personal tax implications, whether we do it through a company or not, how it's going to impact us. There's a few other bits that tie in with running our businesses that will also just cover what is going to happen. So main parties we're going to be looking at tonight are going to be Labour, Conservative and Liberal Democrats, just to see how things fit together. Now, who am I? I am Kimberly Shapcotts, one of the directors at Shapcotts Accountants. There is myself, my co-director Nick, and Melvin, my father, who is reasonably retired these days, but is around and kicking for the odd consultation. Got myself a young family, and also, as you can see, do a few speaking engagements, and there's a few examples of the properties that we've done. Our main focus has been HMOs. We've got a buy-to-let, and really looking for the new opportunities for the new year. So enough about me, enough about other bits and pieces. Let's dive in and start looking at what is going to be happening with taxes moving forward. So I thought I'd start with Labour tonight, as Labour is probably the most extreme, is probably the best way to phrase it. Now, in terms of the corporate taxes, you'll probably have seen that they are looking at increasing the tax rate to 21% and then up to 26% by 2023. Or for smaller businesses, so those with turnover up to 300,000, it will be 19% going up to 21% by 2023. From a personal tax point of view, they're looking at anyone who's earning over 80,000 will start to pay the additional rate tax, which is at 45%, and then anyone over 125,000, they'll be increasing it to 50%. But they are looking at keeping all the other income tax rates and the national insurance the same. The one biggie that will definitely have an impact, which we'll have a look at structures in a second, is the dividend taxes are going to be brought in line with the income tax rates. So at present, for anyone who takes a dividend, the first £2,000 is at 0%. The next bit up to your basic rate tax band, which is around the 50,000, is taxed at 7.5%. And then the higher rate goes up to 32.5%. And typically we don't see any higher tax rates than that, because people tend to manage their taxes so that we don't need to go any higher than that. What they're looking at doing is changing it to be in line with the income tax rates. So that means rather than the 7.5%, it'll be 20%. And rather than the 32.5%, it will be 40%. So that's quite a big impact on anyone who's running a company. Now, the other thing to mention with individuals is the capital taxes route. So if you're buying and selling properties, or you have a buy to let and you decide, I'm not interested in having this one anymore, I'm going to dispose of this property and sell it, what they are looking at doing with the capital taxes, so the gains that you would make on these properties, including if you're doing flips in your own name, which I'd probably say is a slightly dangerous game if you're doing lots of them, but they're going to be aligning the tax rates to the income tax rates. So currently the tax rates for the gain will be 18% on the basic rate tax band. So anything up to 50,000 in your income that you are getting a gain on will be at 18%. And then anything in the higher rate tax bracket will be at 28%. What it means by aligning it is it's going to go from 18% to 20% and from 28% up to 40%. So it makes it a lot more costly selling the different properties. The other thing to mention that Labour has distinctively mentioned is that they're looking at abolishing something called entrepreneurs relief. Now, generally as property investors, it doesn't really kick in entrepreneurs relief because as an investment business, we're not seen to have something that we can get this relief. However, if you've got other trading businesses, so you might be a builder who's also got property investment, your building company, if you sold that on because you've got good contracts, you've got a team of men that are working for you, and you sell that to somebody else to continue running that business, or even if you close that business down as a business, you would get entrepreneurs relief on the disposal of that business. Now, entrepreneurs relief is something that would charge you just 10% tax, basically for all the effort and the work that you have put in, up to a set amount, which has varied from £1 million up to £5 million, depending what the government's done in that tax year. Now, Labour are looking at removing that. So in essence, on the disposal of your business, you'd be looking at the income tax rates again. So if, for example, you made 100,000 from selling your business, you would now be looking at the 20%, the 40%, potentially the 45%, and even the 50% tax rates on selling that business. That obviously is quite a significant difference to the current entrepreneurs relief at 10%. This is quite a big thing for anyone who is got any trading businesses alongside maybe their property portfolio businesses. One thing that is remaining the same, they've not made any mention on, is VAT, which no one seems, they've not made any comment about, so we're assuming that that is the same. Again, most property businesses, it's not relevant. Obviously, it may be relevant if there is any conversion work that we're doing. There's no impact on the 5% if you're taking a residential dwelling to a HMO property. There's potentially no impact on if you're doing new builds. There'll still be at 0% and you'll be able to claim back the VAT. So from some of the development side of things, from the conversion side of things, the VAT side of things looks at the moment to be staying the same based on what we've been told at the moment. The other two things to mention before we just have a quick look at how some of these impacts may change how we set up our business is if you do have employees in your business, which most property companies don't, but as you start to expand your portfolio, you might decide that you want someone in the business to manage your portfolio, or you may want a general maintenance person that you've got employed so you don't have to keep getting contractors in. There's many reasons you might decide to go down that route. Labour are looking at making the living wage £10 per hour for all workers aged 16 and over. So that could be quite a significant cost for the business, as you'll have the £10 per hour plus the employer's national insurance and obviously have to take account of the fact that as an employee they'll be getting holiday, and also you will have to pay into their pension scheme under the auto enrolment policies that are in place. So taking on a member of staff, it's still a good idea if it's right for your business. It's just making sure you've taken account of all of the costs and the implications so that you can make sure you're not going to suddenly find actually it's more than you were expecting it to be. The final thing to mention before we just jump into how to structure things if we end up with the Labour majority is inheritance tax, which for many of us, including myself, is probably quite a while away. However, it's something to be aware of because at the moment we have an allowance, so how much our estate is worth at the date that we're no longer in this world and gone to the next one, is currently 325,000 per person. For a couple, that becomes 650,000, and you can pass any unused allowances onto a spouse. You do have to be legally married, so have signed the paperwork to get that allowance, which gives you up to 650,000. At present, they introduced in a number of years ago something called the nil rate band for your main residence, which actually enabled you to potentially get up to £1 million of allowances, which kind of meant most people who had potentially got their own home, got maybe one property, maybe got a bit of savings, some investments that they've built up over their entire life, potentially had no inheritance tax to pay. What Labour are looking at doing is removing this allowance for the main residence, which means it will take it all back to just the 325,000. So if your own home is maybe 300,000-400,000 that you're living in, plus you've got a couple of rental properties, you might have some investments or bits and pieces, it's not that difficult, especially as a property investor, to actually start to end up going over that 650,000 as a couple, or very easy probably as an individual at the 325,000. So it may not be a problem for the next 20 or 30 years. However, it is known as a voluntary tax because you can do different things to put planning in place. So hopefully you minimise that tax. Now, there's been no comment on changing the rates, so the current rates of 40% potentially would still stand. And that arguably would mean that anything over that amount would be taxed at that rate. It's quite a hefty tax, and if it can be avoided, it's definitely worth trying to set it up in that way. So they're kind of the key changes that Labour are looking at bringing in, and the bits that aren't going to be changing. Now, in terms of ourselves as property investors moving forward, should we find that all of these things happen, I suppose the big question is, how do we want to be organising things? Now, overall, I'd probably say there are still some quite a few benefits going down a limited company route. Now, these are probably more from, rather than tax reasons, practical points of view. Certain things like your inheritance tax allowance, if you've got kids or grandkids, or you may not have grandkids at the moment, by the time we get to that age, there may be grandkids involved. There is the possibility in a company that you can start distributing the shareholdings that you have in that company. So you might start your business. For myself, my kids are too young. So at the moment, it's me and my husband. However, when our kids get old enough, or if you have kids who are old enough, you may want to put some of the shareholdings in or in their name now, which therefore means you've just reduced your estate by the amount that you have given to them as you set your business up. And then that can be expanded over a period of time to help reduce the value of your estate and manage things moving forward, ready to pass things hopefully on to the next generation or even the generation after that. In terms of a company, it gives you a lot of flexibility. So this means that if you don't want any further income after the corporation tax, you can just leave it in the company and it's there for later. Now, obviously, that's a benefit in terms of future planning. Whether Labour get in or not, we have an election every 4 or 5 years. So whether Labour end up being in for 5 years, 10 years, we obviously have a lot of cycles with our political environment. So that means Labour could be in for the next 10 years, but then we may flip the other switch and go back to Tories in 10 years' time. So obviously some of these things, at that point, the tax changes would happen again. We would see what would happen. In a company, it just sits there, whatever happens, and you can decide when you take that income, when it is favourable for you and it makes the most sense. Now, the one key change that will have an impact is obviously the dividend taxes side of things. So at the minute, it's very tax advantageous to put your property in your company, pay your corporation tax, and then pay the dividends out to you from your company. And there's primarily no real tax difference in doing it one way or the other way. With the new changes that would come in under Labour, the potential of tax that you'll have to pay does increase, which potentially means as an investor, we may need to look at buying a property in our own names, because then we won't be paying 20 odd percent. We've got 21 to 26% or 19 to 21%, and then paying a further 20% when the money comes out of the company, which is obviously noticeably different to the 7.5% that is currently being taxed at. So it may change how we buy things. As soon as you get to the higher rates of tax, obviously, it all of a sudden becomes so much better to put it in the company, because if you have it in your own name, you're going to have to pay 40% under the new regime. But if it's in the company, you'll pay the 19, 21, 26%, and then you don't have to take it out. So you don't have to pay that 40%. And then maybe you have a bad year, or you might be finishing your job. You can then take that money out of the company when you want, which is where the flexibility comes in. One thing I say on many of my webinars is that every purchase you make, you have the choice of where to buy it. So just because you have a company doesn't mean you have to buy the property in the company's name. You could buy it in your own name, and then when you get to a certain point, you then go back to buying in the company. It could be you've not got a company, but actually looking at where things are, setting up a company may be the right route, and you buy one or two in the company, and then you look at things and go, actually, my own name may work better for me. Everyone is going to be slightly different, but the main thing is just trying to minimise the impact of the changes and make it still work for you. And obviously with a lot of these things is, depending on the strategy you are going down, it will have an impact on how you deal with things. If you are flipping properties under a Labour government, a company is going to be the most tax efficient route for you to be doing this sort of activity. There's always a risk if you keep doing things in your own name that they may decide that it is not a capital tax, it is an income tax. However, with the changes, it kind of makes no difference. You'll be paying tax at that higher rate, whatever happens. So on that basis, it will make a lot more sense to have it in a company. And if your business isn't turning over 300,000, you'll be at the 19 to 21% rate, which is potentially going to be lower than the 20 or 40%, depending on the gains that you're making. So it may be if you're only getting 10, 20k and your salary is only 20,000, you're okay to do that one in your own name. If you're doing 2 in a year, then you've got a problem, because that second one will probably take you into the high rates of tax. You'll be paying 40%. That therefore means in the company would be better, because you'll only be paying that 19 to 21%, which is better. and then you'll be able to take that money out at a future point when it makes tax sense to do so. If you're going into another flip project, you can obviously reinvest it into the project, and there's no additional tax until you make a profit on the next project. So hopefully that gives you a bit of an inkling of some of the changes under Labour, where you might go with the different bits and pieces. So let's just kind of move on to the other parties, which are slightly less changes, I will say, but they both have their different areas where they kind of are looking at doing different things. So let us move on to Conservatives, the Blues. Generally, they have kind of kept most things relatively similar. They are not doing anything with income tax at the moment, apart from they're looking at increasing the national insurance threshold to 9,500. So that means employees will be paying in slightly less at that lower level. Capital taxes, again, they've not announced any changes, so things will be as they are now with the current guidance that is currently in place. There's no changes to that. However, they have mentioned the entrepreneurs relief side of things. They are looking at doing a review on that to see what may need to be done from that perspective. The VAT side of things, again, there's no comments anywhere on this, so our only assumption at this stage is that they are looking at keeping things, again, relatively consistent and not making any changes. The one thing that they have said for corporation tax is, at the minute it's 19%, and rather than introduce the new 17% rate and reducing it, they'll look at putting a delay on that, and they've not actually put a date when they would look at making any reduction. So the general consensus appears to be that they'd just leave it at 19% and not do any changes at this point in time. From employing people, or even in your own jobs if you are working at the moment, they are looking at continuing to increase the national living wage further and expanding it to include 21-year-olds. So the national living wage at the minute is for 25-year-olds and over. They're looking at bringing the age down to 21 and increasing it slightly. So if I remember correctly, it was either $7.50 or $8.50, the current one, and they're looking at sneaking it up. It's just they're not quite at the £10 rate yet, like Labour are proposing, and not quite the same age. Personal allowance has gone up to, it will be going up to 12,500, so we'll all be able to earn at least 12,500 before paying any tax. So if your only income is from rents, you've obviously got the first 12,500 will be tax-free. So there is potential there that you can have the first property or two, first HMO or first 2, 3, 4 buy-to-lets in your own name. The other positive thing they've done for employees is increase the employment allowance for small businesses. So if you are employing people, you can potentially have a reduction in your national insurance, which makes it more less costly to actually employ somebody, so you can expand your business and take on a team in-house. Now, based on this, the guidance is pretty much the same. So at the minute, going into a company is a tax efficient way of getting your rental income for all the normal practical reasons, cost reasons, tax reasons. So if we end up with a Conservative majority, the general advice will remain consistent. There won't be any significant changes in things. I'd probably say we need to make sure you're looking at, if you have a company, does it make sense to put a payroll through the company, to make sure you're ticking your pension, state pension tick boxes, so you're getting your stamps each year. You still need 30 to 35 years worth of stamps to get your full state pension, depending on your year of birth. So it'd just be to make sure you're ticking that, and then that would help utilise your personal allowance, and you can keep this at a minimum, probably at 9,500, so you're not actually having to pay much or any national insurance to actually make the most of these allowances. So overall, the Conservative approach would leave things roughly where we are, and there won't be any major upsets unless there's any surprises that they bring in afterwards. So let's move on to the final party, which is the Liberal Democrats, who we all probably know probably won't be in as a majority, but if we do end up down a hung parliament route, we may find that they are in a coalition with one of the other parties, so some of their policies may be integrated into what happens. So from their point of view, the income tax side of things, they would be looking at increasing all the income tax rates by 1%. So from our 20, we'd go to 21, 40 to 41, 45 to 46, etc. across the board. So everybody would find that their tax bill is a slight higher, but hopefully 1% isn't a significant number. The one other thing that they very specifically mentioned is scrapping the marriage tax allowance. Now, some of you may be using this if you've got partners, spouses, I should say, because you have to be married to utilise it. One of your spouse is maybe working, the other person is maybe getting dividend income or other income and not fully utilising their personal allowance, and you can pass up to 10% of that away to the other person. So they kind of get taxed less at their tax rate. So it's a nice little thing for those that use it. It's probably not been overutilised, so in terms of the impact on anybody who is using it, it may have an impact on them, but there's a lot of people not making use of it, so probably a small thing. The capital gains tax side of things, they have been a little more brutal, because they would be looking at getting rid of the capital gains tax allowance and abolishing this. Now, the capital gains tax allowance is currently, I think, 11,700, going up to 12,000 in the next tax year. So that means if we're selling a property and it's just a small gain of £10,000, the positive of that is there's no tax to pay because we have an allowance of £12,000. If I've made 10,000 gain on it, I'm not going to be paying any capital gains tax on it because it's covered by my allowance. If you make 20,000, the first 12 is cleared, and then I'm only paying tax on 8,000 of it. So as you can see, it's quite a useful allowance for those that are maybe buying, selling things. The other use that we've seen the capital gains tax allowance is those that do have companies sitting and you want to start passing some of your shareholdings down to children, grandchildren. The stages of doing that include you have to look at how much your company is worth. Now, obviously with property companies, we've got properties in them. So properties can be quite valuable. If you've got 150,000 house and maybe 2 or 3 of them, you've got £450,000 worth of assets there. So your company could be worth something. Now, obviously, if you've got loans against that, that brings down the value of the company. But the first step in moving shareholdings around is looking at the value of the company. So if you said the company is worth 100,000 after taking into account what the assets are, the properties, what the loans are against those properties and other investor loans you may have, you might have a value of 100,000. Now, if you've got 100 shares, then, and you decide actually we want to give 1%, 2% away to the kids, of that 100,000, 1% of 100,000 is £1,000. Now, £1,000, if you were to give your daughter, son, granddaughter, grandson each 1% of the company, that's £4,000 gain that you've just made, or 4,000 that you have just sold to somebody else. that 4,000 would fall within that 12,000 of your allowance. So you would be able to gift those across, pay the capital gains tax, I say in inverted commas, and all the tax is dealt with. You've not had to pay anything, but you have moved some of your estate away from you. So from that perspective, if we lose that allowance, it makes moving shareholdings around a little more difficult. The other implication that they have said is that they would again make the rates the same as the income tax rates, like the Labour manifesto. So then you're getting no allowance and you're paying higher tax rates on this sort of transaction. Now, for share movements, normally you would pay 10% at the basic rate tax band or 20% at the higher rate tax band. So for both of those, you'd be doubling the cost of the tax. So from that point of view, on the capital side of things, the Liberal Democrats have gone down quite a strong stance. The one thing they haven't commented on is the entrepreneurs relief, which obviously, as we've mentioned, Labour has mentioned removing, Conservatives have mentioned reviewing. There's been no comment from the Liberal Democrats on that side of things. That again, they've not made any comment on, so no one's really focused on any changes in that area. Corporation tax wise, they have said that they would look to increase it to 20%. So again, 1%. So they're kind of doing a general 1% over everything based on where things are going. And from the employee's point of view, there's not really been any comments on any changes in how they would look at dealing with employees in your business. So from that point of view, it's not too bad in terms of what they're looking at doing. The main area which is kind of probably of concern from a property investment point of view is that they're really being quite draconian on the capital gains tax side of things. So anyone doing flipping, you would definitely be doing in a company if these changes coming in when you're losing your capital gains tax allowance 12,000 and the tax rates are going up to 20 or 40%, especially if you're starting to do property flips which may be 50,000 gains, you'll be paying a lot more tax in your own name than you would within a company format. The income tax side of things isn't so bad, it's just small increases. So there's probably not lots of planning changes in terms of this side of things. So that kind of covers the three main parties. So as you can see, for some of them it's quite significant changes, for others things are really kind of saying more status quo. Obviously, depending on what the results are tomorrow, we will be looking at, if it's a hung parliament, a mixture of what the different policies are, and we'll have to see where things are going. What we will be doing in January for our property newsletter that we'll be emailing out slightly later than we normally do, but I wanted to just leave it so we could see what the results of the election are and actually start to just see what the impact to us as property investors is going to be. So that will cover off in the beginning of January what the impact is going to be. So it'll give us a chance, if we're allowed to make any planning points before the end of the tax year on the 5th of April 2020, if there is anything that we need to be doing, any changes we need to be making. Obviously, if you've got any deals going through, all we can say is do what you can with what we've got at the moment. If there's obviously any impact following the election, it may be that you may need to tweak things slightly before you actually exchange and complete on things. But touch wood, there's nothing kind of detrimental with what you're doing if there's anything kind of literally imminently completing and exchanging. So let me just finish off with telling you a few dates for the future then, and if anyone's got any questions, please do send them through and we'll just go through any questions that anyone may have in a moment when I've just covered next few bits to give anyone a chance to put those questions forward. So we've got our next spring property webinar, which will be happening in March. It could be an interesting one because we will know exactly where we are with everything and we'll know what's coming in the next tax year. So that will, again, as we always try to do, be relevant to what's happening at the time, with a few reminders depending on how many changes may be happening or not happening, as the case may be. We will be holding one of our premium property webinars on serviced accommodation, which we will be announcing the date in our January newsletter. That will be covering this strategy, how to deal with things, what the different implications, how to structure VAT, all sorts of different bits to help make sure you're doing it in the right and most tax efficient way. So that leaves me to say thank you for listening, and if anyone's got any questions, I will just check with my assistant to see if we've had any questions come through. So I've not had any questions come through just yet, but I'll give you a few moments before we close up. I'm hoping I've not stunned you into complete silence with some of the proposed changes. I think with where we're going, whatever happens, there will be some opportunities and there may be some changes that we need to make within our businesses. So the main thing is be vigilant, make sure you don't bury your head in the sand, and hopefully we can make sure that we minimise the tax legally, and also make sure that we take as much of the profits for ourselves to go and hopefully enjoy and spend and help the economy go by using the disposable income to help others keep their businesses going as well. Oh, so just one question looking at that. So I'm just saying what from the Labour perspective the income tax side of things will be, just to ensure that they understand where that would go. So Labour have said that they're looking at keeping everything the same at the lower end of the spectrum. So in essence, you'd have your personal allowance, which would be the 12,000. After that, you would then get taxed at the basic rate tax band up to the 50,000. In terms of that, that would be any investment income, it would be any capital income from selling the gains that you make on any sales of shares of any properties. That would all be at the 20% tax rate. There's no discrepancy with 7.5% or 10% or 18%. No differences, everything at 20%. Then the high rate tax band will go from 50,000 to 80,000. And again, no differences between dividends. So none of the 32.5, none of the 28 or the 20. It would all be at 40%. Then over 80,000 would be at 45%. And then when you get over 125,000, you'd be at 50% tax. So on that basis, what we'd be looking at doing is probably trying to restrict things to the 50,000 to make sure you're not paying too much tax, unless you're happy to pay the extra tax, and maybe take you up to the 80,000. If you're in a couple, it'd be a matter of trying to maximise it. So you're both earning 50,000 or you're both earning 80,000, and then not get into the more expensive tax rates, which mean you end up losing quite a lot of money and the tax bills start getting to more scary numbers. So hopefully that just clarifies the income tax side of things from Labour's point of view. Obviously, Liberal Democrats, it would just be exactly the same as we have now, which is the same as the Conservative side of things, which is you'd have your 12,000 personal tax, you would have your basic rate tax band from the 12 up to the 50. So for Conservatives, that would be at the 20%. For Liberal Democrats, that would be at 21%. Then from 50,000 up to 125,000. Under Conservative, they're looking at just the 40%. Under Liberal Democrats, the 41%. And then anything over 150 is at the additional tax rate, which is at 45%. And for Liberals would be at 46%. So that just hopefully gives you all the different parties, the income tax side of things, so we can just make sure that that is nice and clear. Okay, well at that I'm going to close our session for this evening, and hopefully you found that useful, just to give you a bit of a flavour of what may be coming, what may not be coming, how it all fits together, so that we can just make sure we're looking at what the right thing is for us to be doing, and make sure that we are planning things in the right way to maximise our businesses and our income and minimise the tax liabilities on a legal basis. I wish you a happy voting day, and we will see what the results are tomorrow or the beginning of next week, depending how quick they get all the votes counted and any discussions that may need to be held. And we will be in touch in January, so make sure you are on our newsletter list so that you receive kind of the update on what is going to actually be happening when we find that out after the election results are announced. Have a great evening.